Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Geron Corporation, ticker GERN. And this is a commercial stage biopharma that is attempting really one of the most fascinating and financially complex resets we've seen in the blood cancer space in quite some time. We're looking at a company that is a textbook case of high-risk, high-reward speculation. It's trying to transition from, well, a decades-long research entity into a successful commercial enterprise with its first approved drug, RYTELO. For you, the learner, this deep dive is a shortcut to understanding how massive accumulated deficits, patent cliffs, and these huge high-stakes clinical bets all converge on a single critical timeline.
That is precisely the central conflict here. GERN is executing a high-stakes commercial pivot for its first-in-class telomerase inhibitor, RYTELO, betting the H2 2026 IMpactMF overall survival readout and 2026 strategic commercial reset will drive a high-value re-rating, despite the $1.8 billion accumulated deficit and ongoing multiple securities litigation.
Okay, let's unpack this. That thesis statement, it sets a very clear marker. 2026 is the moment of truth. But standing against that potential future value is this massive structural hurdle of a $1.8 billion accumulated deficit. And we aren't just talking about current cash burn. We're talking about the total weight of past R&D investment that, hasn't yet generated a return. If a company fails to execute on time, those past losses become extremely relevant to its future financing needs. So we have to start by grounding ourselves in the current financial reality. What does it look like as of the most recent reporting period, Q3 2025?
Indeed. The Q3 2025 financial picture, it reveals a company that's simultaneously attempting rapid investment and managing some unexpected revenue softness. In terms of top-line revenue, GERN reported $47.2 million in net product revenue.
Okay.
Now, that's a decent number for a newly launched product, but the context is crucial here. This was a slight sequential decrease from the Q2 revenue of $49 million.
A sequential decrease. So in the quarter immediately following a major commercial ramp-up, that's a bit of a red flag for investors, isn't it? It suggests the initial launch strategy either stalled quickly or, encountered unexpected resistance. Were they struggling with inventory, or was this a clear signal of demand fluctuation?
Well, management acknowledges it reflects the challenge of sustained demand and that initial low physician adoption, which is a problem we'll definitely explore in detail. But despite the slight revenue dip, the good news, I suppose, is that cost controls are having an effect. The net loss for the quarter actually narrowed to a relatively contained negative $18.428 million.
Okay, so they're tightening the belt.
They are. And furthermore, management lowered its full fiscal year 2025 OpEx guidance to between $250 and $260 million. That's down from an earlier range of $270 to $285 million. This really reflects significant cost discipline amid a challenging launch.
That OpEx tightening is a necessary measure, for sure, especially when we look at the lifeline. What is the runway like?
Liquidity remains solid. It gives the company the necessary buffer. GERN held $421.5 million in cash equivalents, restricted cash, and marketable securities as of September 30, 2025.
So a substantial runway.
A very substantial runway. Management has stated they believe this capital is sufficient to fund projected operating requirements, alongside anticipated net product revenues for the foreseeable future.
$421.5 million is a strong foundation, but it is bearing this structural weight of significant external obligations. This isn't just a reserve against R&D burn. It's collateral against debt, and it's offset by future royalty demands. Let's start with that debt structure.
You absolutely must account for the high cost of development financing. First, they're carrying the $125 million Pharmacon loan. And this isn't just standard corporate debt. The loan is secured by substantially all of GERN's assets, and that includes its most valuable intellectual property, the RYTELO patent estate. This arrangement, it really limits their operational flexibility. It restricts their ability to make certain strategic decisions, like asset disposal or changes in control, without Pharmacon's consent. When your core IP is collateralized, it signals a high level of financial urgency when that deal was struck.
Securing the loan with the IP effectively puts a financial leash on the very drug they are trying to launch. But maybe even more complex, and certainly more far-reaching, is that royalty pharma arrangement. That dictates the long-term cost of capital based entirely on how fast they can execute commercially.
And that's where the high-stakes execution timeline really comes into play. The royalty pharma agreement provided GERN with $125 million upfront. That helped shore up the balance sheet.
Sure.
In exchange, Royalty Pharma obtained the right to receive royalty payments on future U.S. net sales of RYTELO. The royalty rate, it starts at a tiered 7.75% on annual U.S. net sales up to $500 million.
That seems fair enough for a $125 million capital infusion. But the devil is always in the details, right? Especially with the liability multiplier, which seems to directly penalize slow execution. What happens if this commercial pivot doesn't accelerate revenue growth quickly enough?
The nuance is immense, and it's exactly why management is so laser-focused on that 2026 sales acceleration. Royalties continue until Royalty Pharma receives 1.65 times the initial $125 million payment, if that happens by the deadline of June 30, 2031.
Okay, there's a deadline.
There is. However, and this is the crucial part, if they fail to hit that 1.65 times multiplier by that deadline, the royalty payments continue until Royalty Pharma receives 2.0 times the initial payment thereafter.
Okay, let's translate that into practical terms for the listener. That's a potential 35% jump in the total liability owed if they miss the 2031 cutoff.
Yeah.
What does that actually mean for the net present value of RYTELO sales if they lag behind?
It drastically increases the effective cost of capital. I mean, in simple dollar terms, they are committing to paying back $206.25 million if they execute fast enough. That's the 1.65x. But $250 million if they execute slowly. That's the 2x.
Right.
So if the commercial trajectory is slow, the cash flow that was supposed to be theirs post-2031 is still going to Royalty Pharma. This arrangement explicitly ensures RPRX gets paid. And the financial pressure this creates on management is, well, it's palpable. It dictates they must prioritize sustained, aggressive revenue growth immediately, not just for shareholder value, but to contain their own long-term liability.
That really drives home why the flat sequential revenue in Q3 2025 was such a problem.
Yeah.
It wasn't just a missed sales target. It started increasing the odds of hitting that 2.0 multiplier, making the cost of capital effectively higher over time. So speaking of commercial execution, the initial launch clearly sputtered. Let's move into the strategic reset the management has initiated to address those failures.
Right. The early, slow commercial adoption led directly to a complete organizational reset in late 2025. It signaled an acknowledgement of systemic launch failures. Effective August 7, 2025, GERN appointed Harut Samerjian as president and CEO. He brings over 30 years of commercial expertise, particularly in hematology and oncology, and he came in alongside a new chief commercial officer appointed in October 2025. This leadership overhaul was specifically tasked with fixing the disconnect between RYTELO's clinical efficacy and its commercial reality.
And what specifically did this new leadership team diagnose as the core problem? What was preventing U.S. physicians from prescribing RYTELO?
They identified a two-pronged problem. First, there was low U.S. physician awareness, and this was partly a structural issue because the foundational Phase 3 IMerge trial, it was primarily conducted outside the U.S. So American doctors just weren't seeing the data or hearing about the drug in their local clinical circles. Second, and more critically, there was widespread physician discomfort with managing the drug's known key side effects, the cytopenias. Specifically, we're talking about neutropenia and thrombocytopenia.
Let's pause on the cytopenias because this is a clinical trade-off the learner needs to understand fully. RYTELO is a first-in-class drug that offers durable transfusion independence for patients with lower-risk myelodysplastic syndromes, or LRMDS. That's a significant benefit. But what is the risk physicians are worried about when they have to manage neutropenia and thrombocytopenia?
It's a genuine risk-benefit calculation that requires very careful clinical management. Neutropenia is a drop in a specific type of white blood cell, which increases the patient's risk of severe infection.
Right.
And thrombocytopenia is a drop in platelets, increasing the risk of potentially dangerous bleeding. RYTELO, as an inhibitor of telomerase, it temporarily suppresses bone marrow function to eliminate the malignant cells, which is why it can lead to these side effects. So clinicians must actively monitor blood counts, adjust dosage, potentially pause treatment. It's not a simple pill-and-go medication.
I see.
This clinical complexity, coupled with the lack of familiarity due to that ex-US trial, created a huge barrier to initial adoption.
So the immediate strategy, the pivot, is less about raw promotion and more about intensive clinical education, really just hand-holding for physicians to get them over their fear of managing these harsh side effects. What does this surround sound approach actually entail in terms of execution?
It's a highly targeted educational push, and it's focused on three key areas. First, substantially increasing RYTELO brand awareness among U.S. healthcare providers through clinical studies and conferences. Second, refining commercial execution, especially around providing clear, robust protocols for dose adjustment and monitoring to ease that physician discomfort with the cytopenia management.
So basically giving them a playbook.
Exactly. They are trying to show doctors, here is exactly how you manage this. We are making the protocol easy to follow. And third, expanding key opinion leader support, getting trusted voices in hematology to advocate for RYTELO's inclusion in treatment guidelines for earlier lines of therapy.
And this is where we see the transition from the bad news, which was the flat sales, to the potential good news. Because despite the overall flat demand reported in Q3, management is pointing to a structural change happening beneath the hood.
Right.
They're suggesting this educational push is actually starting to land.
So?
What specific metric are they telling us is the real leading indicator here?
It's not the volume of sales, it's the quality of new patient starts.
Oh.
The percentage of new patient starts occurring in the preferred first-line and second-line lower-risk MDS segments. It rose significantly to 36% in Q3 2025. That's up from 30% in Q2. This shift to earlier lines of therapy is absolutely critical for the long-term revenue model.
And why is that shift from 30% to 36% in earlier lines such a strong predictive indicator for future revenue growth?
It connects directly to the duration of therapy. Patients who start treatment earlier in their disease progression in 1L or 2L, they're typically healthier, more able to tolerate the initial cytopenia management protocols, and they're expected to remain on therapy much longer. If patients stay on the drug longer, the cumulative revenue stream improves dramatically. You're generating hundreds of millions more in total sales over the drug's commercial lifetime. If they were stuck launching RYTELO only in later-line sicker patients, the duration of therapy would just be too short to generate the revenue necessary to meet those high pharmacon and royalty pharma obligations.
And this structural shift is backed up by aggressive upfront investment made earlier in the year, which management is confident will drive the 2026 growth story.
Precisely. They undertook a substantial operational scale-up in Q2 2025. We're talking a 20% sales force expansion and a doubling of the medical affairs organization. A doubling. Management stated explicitly that these expanded teams were hired, trained, and deployed throughout the summer and early fall of 2025. So they are banking on the newly deployed, better-trained teams, armed with clearer monitoring protocols to drive the full revenue impact that they expect in 2026.
But this massive investment, doubling medical affairs and expanding the sales force, that comes at a P&L cost right now. What risk does this high upfront spending pose if the 2026 revenue acceleration doesn't materialize as planned?
Well, it significantly increases the burn rate risk if adoption stagnates. They cut general OpEx guidance, sure, but they aggressively increased commercial headcount. They're essentially betting that the improved efficiency and patient quality we saw in Q3 will rapidly scale up in 2026. If the new sales team fails to convert that improved patient start quality into sustained overall volume, they will have severely burned through a large chunk of that $421.5 million cash cushion without generating the required return on investment.
Which would force them closer to a potentially dilutive capital raise much sooner than anticipated.
Much sooner.
We also have to contextualize the competitive environment RYTELO faces in the LRMDS market. I mean, it's a first-in-class telomerase inhibitor, but it's not operating in a vacuum.
Not at all. RYTELO is locked in intense competition, primarily with Bristol-Myers Squibb's Reblozyl, or luspatercept. RYTELO, through trials like COMMANDS, has established a very strong foothold, and it's expanded its eligible population, making it the established player in earlier lines. For RYTELO, the FDA label limits its use to high transfusion burden patients, HTB.
Okay, let's clarify that technical limitation for our listeners. What does high transfusion burden actually mean, and what percentage of the potential market does that automatically exclude?
HTB means the patient must be dependent on transfusions, requiring 4 or more units of blood every 8 weeks. It's a very strict requirement.
4 or more?
4 or more. So if a patient only needs, say, 3 units of blood every 8 weeks, even if RYTELO is clinically a perfect fit because of their disease genetics, the physician legally cannot prescribe it under the current label. This restriction immediately excludes the moderate transfusion-dependent LRMDS population, which is a significant chunk of the market. So while RYTELO's mechanism is differentiated, its label restriction, combined with the required management of cytopenias, means it faces a much higher initial barrier to entry than Reblozyl in the day-to-day clinical setting.
So we have a clear battle plan for the current market victory adoption problem in LRMDS. by focusing on physician education in earlier lines. But that plan alone might not be enough to justify the future high-value re-rating. We have to now shift to the massive binary upside potential, which is contingent entirely on the success of the pipeline. Let's pivot to myelofibrosis.
Right. We are transitioning from the current commercial struggle to the future blockbuster potential, which is the myelofibrosis opportunity, or MF. This is the high-risk, high-reward component of the investment thesis. And it revolves around the Phase 3 IMpactMF trial. This trial targets relapsed or refractory MF patients, so those whose disease has progressed or who have become intolerant to a prior J inhibitor treatment. This is a population with just dismal prognosis.
The relapsed refractory MF population is desperately in need of options, given their extremely poor survival rates after a JAK inhibitor failure. But what makes this specific trial such a binary, high-stakes bet for GERN?
It's the sheer ambition of the primary endpoint. The IMpactMF trial reached full enrollment as of the end of September 2025, which is a major operational milestone in itself. But the primary endpoint is overall survival.
OS.
In biotech, choosing OS is the ultimate strategic gamble because it is the most definitive, hardest endpoint to hit. Most competitors in the MF space focus on less definitive, softer measures like spleen volume reduction or symptom scores.
Things that can lead to an accelerated approval.
Exactly. If RYTELO successfully hits the OS endpoint, it proves a genuine disease-modifying effect. It differentiates it significantly from just symptomatic treatments. If it fails, the trial fails. There is no middle ground.
Why did GERN choose such an immense strategic risk? I mean, if they fail to hit that OS bar, they get nothing, whereas a competitor focusing on spleen volume might still gain an approval.
They chose it because the potential reward justifies the risk. The earlier data suggested they had a drug that could offer a massive, clinically meaningful benefit, potentially transforming patient outcomes. Analyst estimates suggest success in IMpactMF could potentially double the entire RYTELO commercial opportunity. It would place it well into the low to mid-billion-dollar peak sales range.
And to get that, you need a blockbuster endpoint.
To realize that kind of re-rating, you need a defining blockbuster endpoint, and OS delivers that.
The high-stakes nature must be justified by strong precedent data. What did the Phase 2 data show that gave them the confidence to go all in on OS?
The rationale comes from the Phase 2 IMbark study in these RRMF patients. That study showed RYTELO's median OS of 33.8 months.
33.8.
Which is a staggering number when you compare it to real-world data for best available therapy in this specific, desperate population, which historically averages only around 12 months.
That benefit, more than doubling survival, sounds incredible. But, real-world data can be notoriously messy. Are we comparing apples to apples here? What are the risks that the Phase 3 results might regress toward the mean when it's tested rigorously in a controlled setting?
That is the multi-billion-dollar question. RWD can suffer from selection bias, meaning that 12-month figure for best available therapy might not be perfectly representative. However, the magnitude of the difference, 33.8 months versus 12 months, it's so vast that even if there is some regression toward the mean, the drug still has a high probability of demonstrating a statistically and clinically significant benefit over the control.
Assuming the Phase 2 results hold up.
Assuming the Phase 2 results accurately reflected the drug's true effect. If the Phase 3 IMpactMF data validates even a substantial fraction of that benefit, it fundamentally validates RYTELO as a disease-modifying agent, making the OS endpoint absolutely worth the risk.
So we have a clear binary outcome coming, and the timeline defines GERN's near-term valuation. When does the market get its first critical glimpse into whether this OS bet is paying off?
The crucial moment is the H2 2026 interim analysis for overall survival. This analysis is planned to occur when roughly 35% of the total planned enrolled patients have died.
Okay.
This is the first statistical hurdle that will determine if the trial is stopped early for overwhelming efficacy, which would be the ultimate bull case scenario, or if the initial signal is strong enough to continue toward the final analysis, which is projected for H2 2028.
So that H2 2026 readout is the defining binary catalyst for GERN's valuation over the next 18 months. And looking even further down the line, GERN isn't putting all its MF eggs in the relapse refractory monotherapy basket. They are already developing strategies to move RYTELO into even earlier lines of therapy for myelofibrosis.
Absolutely. Moving into frontline therapy is the next logical step. You're targeting a much larger patient population. They're advancing development work into combination therapies, specifically combining imetelstat with the JK inhibitor ruxolitinib in frontline MF, and combination trial data for this is also expected in 2026. If the IMpactMF trial is positive, this combination approach allows them to quickly compete in the largest segment of the MF market, leveraging the new commercial teams they've so aggressively deployed.
That timeline is just jam-packed. The commercial pivot acceleration hitting in 2026, potential EU launch preparations, and the massive IMpactMF OS interim analysis in H2 2026. That year is entirely make or break. But now, we have to shift away from the clinical and commercial opportunities and focus on the non-clinical structural risks that could absolutely derail this 2026 growth story. Let's start with the legal environment.
This is a massive operational headwind. GERN is defending against multiple securities class action lawsuits that were filed in March of 2025 and were subsequently consolidated as Geron Corporation securities litigation.
Litigation is expensive, but what specifically are the plaintiffs alleging that caused such an immediate and negative reaction from investors?
The core allegation is that the company overstated RYTELO's commercial potential and concealed material adverse facts regarding the launch. The plaintiffs specifically point to the disclosure made on the February 26, 2025 earnings call. That call revealed the flat revenue trends in early 2025, combined with the lack of awareness among healthcare providers and the high burden associated with the drug's monitoring requirements. This disclosure was followed immediately by a significant stock drop, which forms the basis of the suits. They argue management knew these deficiencies existed but didn't disclose the severity until the poor Q1 numbers forced their hand.
Ain't Geron's response.
Geron, of course, filed a motion to dismiss the consolidated amended complaint in October 2025.
Regardless of the eventual outcome, defending against a securities class action requires substantial expenditure of legal fees and, maybe more importantly, distracts management from focusing solely on the critical commercial pivot we just discussed. How costly is this management distraction during the most important launch period in the company's history?
The cost is immense, and it's non-monetary. The CEO and the C-suite are dedicating hundreds of hours to discovery, document review, and depositions time that should be spent refining sales protocols, addressing physician education gaps, and preparing for those 2026 catalyst readouts. This operational drain at this crucial juncture increases the risk that they might fail to execute the commercial reset simply because their attention is split between the courtroom and the market.
The second major structural vulnerability is intellectual property protection, which is facing an imminent threat that adds immense pressure to the commercial timeline.
We have a looming crucial deadline, the U.S. composition of matter patent expiration in December 2025.
Okay, that's the big one.
That is the gold standard of IP protection, the patent that covers the chemical structure of the drug itself. Once that expires, the drug is inherently vulnerable to a generic challenge.
December 2025 is basically right now. How does GERN pivot to protect RYTELO once that core patent is gone?
They must rely heavily on regulatory and method of treatment protection. Specifically, they'll rely on orphan drug exclusivity, that's 7 years in the U.S. and 10 years in the EU following approval.
But that only covers this one indication.
Correct. It only protects the drug for the specific indication, in this case, MDS. They also rely on method of treatment patents, which expire later. For instance, the EU method of treatment patents expire in November 2033.
Can you explain the difference in protection? I mean, composition of matter is a fortress. What is method of treatment protection?
Composition of matter is a blanket protection. It covers the molecule regardless of how it's used. Method of treatment patents are much narrower. They only cover the way the drug is administered, for example, treating MDS. A generic competitor can challenge this protection more easily, arguing their generic is being used off-label, or that the method of treatment is obvious. So while orphan drug exclusivity provides a vital shield, the imminent expiration of the core patent significantly increases the risk that competitors will launch legal challenges designed to erode or shorten the exclusivity period. And that would severely harm GERN's long-term revenue projections if they're successful.
And finally, we have to address internal operational vulnerabilities, things related to financial integrity and compliance. This speaks directly to the quality of management and its operational scaffolding.
That's the identified material weakness in internal controls over financial reporting, or ICFR, as of September 30, 2025. Specifically, management flagged deficiencies in the design and operation of certain information technology general controls, or ITGCs. These controls cover user access and program change management for critical systems, like their enterprise resource planning and payment processing systems.
This sounds pretty technical. To put this simply for the listener, an IT general control weakness means that the systems used to track money and pay vendors might be vulnerable to unauthorized changes or data corruption. Why is this an absolute red flag for investors in the SEC, especially during a high growth phase?
Well, it speaks to the integrity of the data being reported. Now, GERN stated this weakness did not result in a material misstatement in the Q3 2025 financials. But the lack of proper user access controls means, hypothetically, unauthorized personnel could potentially alter financial data, payment instructions, or inventory records without adequate oversight. For the SEC and for investors, this is a major regulatory concern because you rely on those systems to ensure your reported revenue and OpEx figures are accurate and protected from internal malfeasance or even just simple errors.
So they're fixing this.
Management is currently remediating this weakness, but it is critical for long-term regulatory compliance and investor confidence that this be fixed swiftly before the expected 2026 revenue surge overwhelms their current control environment.
This has been a deep dive into a company operating on a tightrope. We've charted the financial constraints from the $1.8 billion accumulated deficit and the pressure from the Royalty Pharma multiplier. We've assessed the strategic pivot under new leadership, which is attempting to convert patient quality into long-term revenue. And we've detailed the concentrated binary risk in a myelofibrosis pipeline, all while managing severe operational headwinds from securities litigation and imminent patent expiration. This forces us to the final verdict. How should investors weigh this speculation against the necessity of immediate, flawless execution?
The investment decision today, it fundamentally boils down to believing that the 2026 inflection point, that's the commercial acceleration, coupled with clinical success, outweighs the certainty of current entrenched risks. The market is currently assigning a substantial discount to the stock. It's trading at a market cap that is near about half of what Royalty Pharma implied in their $125 million investment calculations. So the tension is high.
Let's define the scenarios clearly. What does the bull case need to achieve in 2026 to justify a massive re-rating?
The bull case hinges entirely on two non-negotiable achievements in 2026. First, successful execution of the commercial pivot must convert that improved 1L, 2L patient adoption into sustained, accelerating revenue growth that significantly outpaces the Q3 2025 flatness.
They have to prove the model works.
They have to prove they can handle the clinical complexity and overcome the competition. Analysts cite peak sales potential for RYTELO in LR-MDS up to $600 million if executed successfully. Second, and most impactful, is the delivery of a positive H2 2026 IMpactMF OS interim analysis. If that data is strong enough to signal overwhelming efficacy, or at least highly positive results, the current speculative valuation is clearly unjustified, and the stock is set up for a massive re-rating.
Because it would de-risk the pipeline.
And potentially double the drug's addressable market.
And what about the high-stakes failure scenario? Given the structural debt and the accumulated deficit, the consequence of failure appears pretty severe.
It is much darker. The failure scenario occurs if the commercial pivot fails to sustain growth. Maybe physician comfort with cytopenias doesn't materialize, or the duration of therapy remains short. And crucially, if the IMpactMF OS interim analysis disappoints, the consequences are immediate. The immense accumulated deficit of over $1.8 billion, combined with the high cost of ongoing litigation and the vulnerability from the patent expiration, would make the stock too high risk prior to the definitive H2 2028 final data readout.
And then have to raise money.
Failure here would almost certainly necessitate further, highly dilutive capital raises to sustain operations and reach that final data point, severely damaging shareholder value.
This deep dive into Geron has taken us on a journey right to the financial, clinical, and operational tightrope walk GERN faces. We started with the financial reality, moved through the critical strategic commercial refit under new leadership, and ended at the highly concentrated binary risk in the myelofibrosis pipeline and the ongoing distractions of the courtroom and internal control remediation. The story of GERN is truly the story of a biopharma company staking its entire future on 2026.
As a final provocative thought for you to consider, reflect again on the specific structure of the Royalty Pharma agreement. It's structured to guarantee RPRX a minimum return of 1.65 times their investment by mid-2031 or 2.0 times thereafter if that initial deadline is missed. So considering this leverage structure, which essentially rewards RPRX the longer it takes GERN to generate sales, how much implied commercial confidence does that debt structure truly reflect? And how much pressure does that put on current management to prioritize immediate sales figures over every other metric moving forward? It's a ticking clock built directly into their financing structure.
A compelling question that sits right at the heart of the risk and the reward for GERN. Thank you for walking us through this deep dive.
Risk defined, portfolio protected.